Investors woke up to news that no one expected to see so soon. Gold hit a new historic record, surpassing the impressive mark of $4,200 per ounce. To put this in perspective, this represents an increase of almost 60% in 2025 alone, something not seen in decades. Those who follow the market know that movements like this don't happen by chance. It's the result of a complex combination of economic, geopolitical, and psychological factors that are transforming gold into the absolute protagonist of current investments. Imagine a metal that for centuries has been synonymous with wealth and security being disputed by investors from around the world, from large central banks to small investors seeking to protect their assets. This is the scenario we are living now. The race for gold is fierce, and the soaring price is just the tip of the iceberg. Financial experts point out that the movement is driven by expectations of changes in monetary policies, global trade tensions, and signs of economic slowdown in major powers. Each of these elements individually could affect the market. Together, they create a perfect storm that puts gold at the center of attention. If you think this is just newspaper news, think again. Every cent of gold's current appreciation reflects strategic decisions by investors seeking security in times of uncertainty. And according to analysts, this may be just beginning. One of the main drivers behind gold's surge is the possibility of interest rate cuts by the Federal Reserve, Fed, the central bank of the United States. For those unfamiliar, interest rates define how much it costs to borrow money in the US. When these rates fall, investments considered safe, such as treasury bonds, pay less, and gold becomes an even more attractive alternative to protect assets. In recent months, the Fed has signaled that it could reduce interest rates to stimulate the economy, which shows signs of slowing down. This simple movement lit a warning signal in the market. Investors began to realize that keeping money in the bank could yield less than investing in gold, which historically maintains its value in times of uncertainty. Market psychology also comes into play here. Every time there are rumors or signs that interest rates will fall, large investors start buying gold in advance. This chain effect makes the price rise even faster, as if everyone were rushing to secure their piece of this safe haven before it's too late. Analysts highlight that even a small reduction in interest rates of just 0.25% or 0.5% can generate waves of gold purchases by investment funds and central banks. In other words, gold isn't rising just because it's beautiful or rare. It's becoming a strategic choice to preserve wealth, especially in times when paper money seems to lose strength. Another major driver of gold prices is the worsening of trade tensions between the United States and China, two of the world's largest economies. Whenever these two powers enter into dispute, whether over tariffs, technological restrictions, or political disagreements, global financial markets feel the impact almost immediately. And when the scenario becomes uncertain, investors run to assets considered safe, and gold is the absolute king in this race. To understand better, imagine the financial market as a large chessboard. Each move made by Washington or Beijing is observed under a magnifying glass by investors around the world. When news emerges of possible embargoes, sanctions, or additional tariffs, fear of instability skyrockets. The consequence, a rush for gold, which functions as a safe haven amidst the economic storm. In recent months, several rounds of trade negotiations have failed to bring definitive solutions, and this has left the market nervous. Investment funds, banks, and even individual investors have begun to increase their positions in gold, anticipating that financial volatility could continue or even worsen. This behavior generates a chain effect. The more people buy, the more the price rises, and the more attractive it becomes for those who haven't yet joined this wave. Analysts emphasize that if this trade dispute continues without clear resolution, gold may maintain its upward trajectory, consolidating its role as a shield against global uncertainties. In addition to trade tensions, another element driving gold is the economic slowdown in China, accompanied by deflationary pressures. For those not accustomed to the term, deflation means that prices of goods and services begin to fall generally, something that at first glance may seem good, but in practice indicates that the economy is losing strength. When China, the world's second-largest economy, faces this type of problem, global investors become alert. After all, China is responsible for a huge portion of international trade. A weak economy there can generate less demand for products, lower profits for global companies, and uncertainty for financial markets. And in scenarios like this, gold becomes a natural refuge. Investors see gold as protection against economic instabilities because, unlike money in banks or stocks, it maintains its value even when currencies lose purchasing power. In recent months, with data showing that Chinese growth is slower than expected, demand for the precious metal has skyrocketed. Large investment funds, central banks, and even individual investors have begun to increase their gold reserves, directly contributing to the historic price record we are seeing today. Analysts warn that if the Chinese economy continues to show signs of slowdown, gold may maintain its appreciation pace, reinforcing its role as the safe investment in a world full of uncertainties. If you think the historic record of $4,200 per ounce is the peak, prepare yourself. Financial analysts and precious metals experts warn that gold still has potential to rise even more, potentially reaching an impressive $5,000 per ounce in the coming months. This type of projection is not just speculation, it is based on a combination of economic, geopolitical, and psychological factors that continue to shape the global market. To understand better, think of gold as a kind of thermometer of the world economy. When uncertainties, trade tensions, changes in monetary policies, or signs of slowdown in major economies arise, investors feel insecure about where to put their money. And it's exactly at that moment that gold shines, because it offers security and value preservation. Furthermore, major central banks are increasing their gold reserves to protect their currencies and economies. This creates continuous buying pressure, pushing the price even higher. Investment funds, individual investors, and even companies are starting to acquire gold preventively, anticipating future crises or instabilities in the financial market. Each purchase generates a cascade effect. The more people enter the race for gold, the more its price rises, creating a cycle of appreciation that can be difficult to interrupt. Another important point is investor psychology. When gold reaches historic records, like the current is $4,200, many people realize it's now or never. This sense of urgency can accelerate demand even more, fueling price increases. Analysts warn that if current factors, low interest rates in the US, trade tensions, economic slowdown in China, and global instability persist, gold could reach $5,000 or even surpass this level, transforming 2025 into a historic year for the precious metal. In summary, gold is not just rising, it is establishing new standards of value and security, showing that even in times of uncertainty, it is possible to protect wealth and invest strategically. For those who follow the market, every dollar of gold is an opportunity to understand the movements of the global economy and position themselves intelligently before new records are broken. Gold, for centuries, a symbol of wealth and stability, is experiencing an unprecedented historic moment. This Wednesday, October 15, 2025, the price of the precious metal surpassed $4,200 per ounce, marking an increase of almost 60% in 2025 alone. For many investors, this appreciation represents more than a number. It is a clear sign that the financial world is undergoing a profound reconfiguration, where security and strategy become more important than ever. The phenomenon is not isolated. It is the result of a perfect storm of economic, geopolitical, and psychological factors that push investors of all profiles to reconsider their investment decisions. Among these factors, the following stand out: expectation of interest rate cuts in the US. The Federal Reserve has signaled possible interest rate reductions, decreasing the return on traditional investments and increasing gold's attractiveness as a safe haven. Each signal of reduction triggers an immediate rush as investors seek to protect their capital before the market adjusts. Trade tensions between the US and China, trade clashes, tariffs, and technological disputes between the planet's two largest economies generate global uncertainty. In times like these, gold functions as an anchor of stability, an asset that maintains its value even when stock markets and currencies fluctuate. Deflationary pressures in China. The economic slowdown in China, combined with falling prices of goods and services, increases the perception of global risk. Investors from all continents turn to gold to preserve wealth, creating demand that fuels the continuous rise in the metal's price. But the scenario doesn't stop there. Analysts project that if these conditions persist, gold could reach $5,000 per ounce in the coming months. A value that until recently seemed distant now becomes a real possibility. This projection is based not only on cold numbers, but on human behavior, market psychology, and strategic decisions by central banks and large investors. The impact of this appreciation is global. From small investors to financial giants, everyone is re-evaluating their portfolios, incorporating gold as a key element for protection against crises, volatility, and economic uncertainties. Each purchase movement not only raises the price, but reinforces gold's role as an indispensable strategic asset. In 2025, gold ceased to be just a precious metal. It became a thermometer of the global economy, reflecting every change in monetary policies, every trade tension, and every sign of economic slowdown. And for those who know how to observe, it offers a unique opportunity to protect assets, anticipate market movements, and position strategically before new records are broken. Gold's historic record doesn't just affect large investors or central banks. It has direct effects on the financial lives of millions of people around the world. With the price above $4,200 per ounce, financial products linked to gold, such as ETFs, investment funds, and even futures contracts, become strategic alternatives for asset diversification. For the average investor, this appreciation also raises important questions. When is the right time to buy or sell? Analysts emphasize that gold works best as long-term protection. Even if it fluctuates in the short term, historically it remains resistant in crises, preserving the value of money and offering financial peace of mind in moments of volatility. Furthermore, the rise in gold influences other commodities and correlated markets. For example, silver, platinum, and palladium tend to follow the pace, while currencies of more vulnerable economies may suffer devaluation against the dollar, further increasing the perception of gold's security. Another point worth highlighting is gold's role in retirement strategy. Experts recommend that investors over 35 years old consider including the metal in their portfolios as a way to protect accumulated wealth, balancing riskier investments with assets that historically resist economic and geopolitical crises. Beyond the financial aspect, the movement also reflects global confidence in economic policies and monetary stability. When gold skyrockets, it's a warning signal for governments, banks, and investors. There is uncertainty, there is risk, and it's time to rethink strategies. This phenomenon is, therefore, much more than numbers. It's a window to understand the world economy in real time. The rise in gold doesn't affect everyone the same way. Institutional investors, such as banks, pension funds, and sovereign funds, are taking advantage of the moment to strengthen their reserves, ensuring protection against possible future crises. For them, gold functions as an anchor of stability, allowing them to balance portfolios that include stocks, bonds, and other more volatile assets. On the other side, individual investors are reacting more strategically and sometimes even cautiously. Many who had small gold reserves, whether in bars, coins, or funds, are increasing their positions, realizing that appreciation may continue in the coming months. Others, who had no contact with this market yet, are quickly seeking to learn how to buy gold safely, how to store it, or invest in financial products linked to the metal. There are also those who use gold as indirect protection for businesses and investments. Exporting companies, which depend on exchange rates and the global economy, are buying gold to protect themselves against dollar fluctuations and uncertainties in international markets. Meanwhile, investors operating in correlated commodity markets, such as silver and platinum, are adjusting their strategies, knowing that gold movements often indicate trends for other precious metals. This diversity of reactions shows something very important. Gold is not just an investment, it's an indicator of global investor behavior, reflecting confidence, fear, strategy, and risk perception. Each purchase or sale is a signal about how people are interpreting the economic and geopolitical scenario. Furthermore, the increase in gold prices is also awakening interest in new markets and regions. Emerging countries concerned with financial stability are increasing their reserves, while high-income investors worldwide are studying gold as part of a broader strategy for asset protection and sustainable growth. With gold surpassing as $4,200 per ounce, the question many ask is how to take advantage of this appreciation without running unnecessary risks. The first thing to understand is that gold is not just an investment asset. It is protection against economic instability and an opportunity to diversify your portfolio. One of the most direct ways to take advantage of the rise is to invest in physical gold, such as bars and coins. This type of investment offers complete control over your assets, ensuring that they are protected even in scenarios of great financial volatility. It is ideal for those seeking long-term security. Another alternative is to invest through gold funds, or ETFs. These products allow you to track gold's appreciation without needing to store it physically, facilitating investment, especially for those who are just starting. It's a practical way to benefit from the rise and still maintain liquidity, being able to sell when the price reaches levels you consider strategic. The viewer can also use gold as protection for existing assets. For example, if you have investments in stocks or real estate, part of your capital can be allocated to gold to balance the portfolio. Historically, when stock markets face decline or currencies devalue, gold maintains its value and reduces the impact of losses in other investments. Furthermore, following the market strategically makes all the difference. Knowing the right time to buy or increase positions requires attention to factors such as interest rates in the US, trade tensions, and global economic indicators. Gold offers opportunities not only for financial gains, but also for protection and strategic planning. Investing in gold doesn't just mean following the price. It's understanding the global scenario, acting intelligently, and using this moment of historic appreciation to build a solid foundation for your financial security, whether for retirement, emergency reserve, or long-term planning. For those who already understand the basics and want to go further, there are intelligent ways to position yourself in the gold market without taking unnecessary risks. The first strategy is diversification within gold investment itself. Instead of concentrating all capital in physical bars, you can combine physical gold. Bars and coins guarantee direct control over the asset. Gold ETFs. Allow quick liquidity and exposure to gold prices without needing to store it. Gold investment funds. Managed by professionals, they offer strategic management, taking advantage of rising opportunities and protecting against sharp declines. Another advanced technique is to invest gradually, known as the dollar cost averaging strategy. Instead of buying everything at once, you acquire small amounts periodically. This helps reduce the impact of market volatility, as gold prices can fluctuate in the short term, even during an upward trend. More experienced investors also monitor global economic signals, such as Federal Reserve decisions on interest rates, China's growth indicators, and movements in correlated commodity markets, such as silver and platinum. These signals help identify strategic entry and exit points, maximizing gains and minimizing risks. Furthermore, it's important to consider gold as asset protection, not just as speculative investment. Part of the capital can be allocated to preserve wealth, balancing other riskier assets such as stocks, cryptocurrencies, or real estate. This balance is what guarantees financial resilience, even in moments of global uncertainty. Maintaining discipline and patience is essential. Gold's rise may continue in the coming months, but the secret lies in making strategic decisions, monitoring the market carefully, and avoiding impulsive movements. Gold rewards those who act with intelligence, information, and planning, transforming historic appreciation into a real opportunity for growth and financial security. With gold surpassing $4,200 per ounce and prospects of reaching $5,000, the effects of this appreciation go far beyond the precious metal market. Each movement in gold prices has ripple effects on other investments, currencies, and the global economy. And understanding this dynamic is essential for those who want to protect or expand their assets. First, elevated gold tends to impact the currency market, especially those of countries with more vulnerable economies. When gold rises, the dollar usually strengthens and local currencies may devalue, affecting imports, exports, and borrowing costs. For global investors, this creates opportunities for protection and strategic adjustments in their portfolios. Second, gold's appreciation influences other commodities, such as silver, platinum, and oil. Historically, when gold soars, these markets tend to react, either through direct correlation or through the movement of investors seeking diversification. This means that by following gold, you can also identify trends in other assets, increasing your chances of profits or protecting existing investments. Another important effect is in the behavior of institutional investors. Pension funds, central banks, and large investors tend to increase exposure to gold when they perceive global instability. This creates additional demand that fuels appreciation, transforming each price peak into a strategic opportunity for those correctly positioned. For the individual investor, this means that following gold is not just observing the metal's price, it's also understanding how it connects to interest rates, monetary policies, inflation, economic growth, and even trade tensions. Each relevant piece of news can be a trigger for intelligent decisions, whether increasing position in gold or adjusting other investments to balance risk and return. Furthermore, this historic appreciation of gold reinforces the idea that investing strategically and informedly is essential. Those who take advantage of these opportunities with planning, diversification, and attention to the global scenario manage to transform gold's rise into an instrument of protection and financial growth, even in times of economic uncertainty. If you are finding this information about gold's historic rise useful and want to learn more about investments, finance, and how to protect your assets, don't forget to like this video, subscribe to the channel, and share with friends or family who also want to take advantage of these opportunities. Each subscription helps bring more detailed and strategic content to you, showing how to navigate financial markets safely and intelligently. Stay on top of each new market update, follow the trends, and learn to transform moments of appreciation, like this one with gold, into real growth for your assets.